Good afternoon, a very warm welcome to all our viewers. Today's Education on Air will be presented by a highly respected individual who is a certified public accountant and certified fraud examiner with over 20 years of personal experience as a business owner, consultant, and trainer in the area of accounting, tax, and loss prevention. His current endeavors keep him actively involved in the Denver, Colorado business community as a provider of tax, accounting, and advisory services to small businesses and nonprofit organizations. To balance his busy work life, he also volunteers with a number of organizations as an advisor, mentor, and board member. At home, he enjoys reading, cooking, exercising, and playing sports such as tennis and basketball. It is my pleasure to introduce to you Mr. Lou Orlano. If you have any questions for Mr. Orlano, please press the Q&A bubble on the left side of your screen and type in your questions, and he will answer them at the end of his presentation. Hello, Mr. Orlano. It's great to have you with us on EMD Education on Air. Would you like to tell us a little bit more about yourself and what you would be educating us with today?
Sure. Good morning or good afternoon, wherever you may be, as it is still morning here in Denver, actually. A little bit more about myself. If you look at the picture on the screen, while that isn't me, that could easily be me. I actually, last weekend, just hiked to the top of the tallest peak in New Mexico, and that was really fun. And I've hiked to the top of a number of peaks here in Colorado, and there's nothing like standing on the top of a mountain and looking out over the countryside. Just a wonderful opportunity we have here in Colorado to enjoy the beauty of nature. And so hopefully wherever you are, you get to do some of the same. Some of you might be out there wondering what USA is doing in the World Cup. I will let you know that I think it's still at halftime, and it's 0-0. So go USA. Well, that aside, so one of the things we're going to talk about today, and the webinar is short, so I'm going to do my best to give you some information, and hopefully you'll pick something up or learn something. I wanted to focus on some of the things that I get questions on the most in today's short time that we have. And so hopefully we will touch on something that you'll have a question about, and if not, as you heard from the introduction, we will have time at the end for you to ask me some questions, and hopefully I will be able to get to all of those. So, business expenses, can I deduct this? Now, again, I can't cover everything today, and I can't cover all of the different nuances, but I'm going to try to cover stuff in general terms as much as I can. And so hopefully, again, that will give you some information that is useful for you and that you can use back in your everyday circumstances. So let's go ahead and start. So business expenses, what can you deduct? Well, there are two general criteria that can be applied to every business expense. And this is a good place to start. So if you're having a question about something, if you're not sure, is this something that I can deduct in my business? Now, this is definitely the place for you to start, is to look at these two criteria. And I hope you can see the slide very well. I was thinking about a couple different things with this this theme, this motive behind. I don't know if how you track your expenses in your businesses, if that's you running from the IRS because they're coming after you, or maybe even more importantly, or hopefully this applies to everybody, is that in everything that you do, that's you running your business. And you may feel like that sometimes, that there's so much going on that you feel like more than one person and you're wearing multiple hats. So hopefully you think about it in a positive way as opposed to running from the IRS. And I think if you follow some of these general guidelines that I'm going to give you today, I think you'll be able to sleep easy at night and you won't feel like you're having to run from the IRS. So the first point, ordinary. What's an ordinary expense? And in just general terms, it's an expense that is common for your type of business. So for example, I know that today the invitation was gone out and generally referring to people or referred to people in the medical profession, but uh, this same idea, the same concept can apply to you in no matter what type of business. So I'm going to try to give examples that might be geared more toward a medical professional, but you could think of it as applying to your business as well. So ordinary. So let's say you run a dental office. What would be ordinary in a dental office? Well, to begin with, there are all kinds of different medical supplies that you need in the business. It could be thinking of uh, extraction tools for extracting a tooth. Heaven forbid any of us has to go through that again, or if you ever have. So that would be something that is used in that type of business. If you are an accounting business, one of the things that's very common for us in the accounting business is our accounting software, all the different software that we use, tax preparation software. So that would be something that's very common to an accounting business. If you're in a real estate business, I'm sure you have a lot of advertising, and actually advertising probably applies to all of us. So if it's an advertising expense, that would be a common expense. If you have a business that's maybe sort of off the wall, maybe this isn't so off the wall, but let's say a waste management service, you probably have big trucks to go out and pick up the trash or whatever kind of waste. Now that would be something in an accounting business. If I owned a garbage truck and tried to have it in my business, well, it probably wouldn't make much sense. It's not common to accountants because I don't know any accountants that have a garbage truck on their books. So that just kind of gives you an idea of what would be kind of considered common. Is it something that most people in your industry would be having to buy, having to use in their business? And then the second thing is it necessary? So again, kind of ordinary and necessary, in my mind, kind of go hand in hand. And so thinking of using some of the same examples I already used in the dental office, there are tools, there are supplies that really the dentist needs to use on maybe not every patient, but on patient A, patient B, patient C. So those would be items that would be necessary. I guess the IRS could argue that are the magazines in the waiting room necessary? Well, maybe they're not necessary. Maybe somebody could come in with their cell phone and check email and do things like that. But I would say that generally speaking, in most dental doctor's office you go to, there's usually magazines sitting out there in the waiting room so that people have something to do to pass the time. There might also be a TV. Again, maybe you provide Wi-Fi service so that somebody comes in, they can keep working or doing whatever they need to do to pass the time. So those are things that would generally be considered either common and ordinary, and then again necessary. And so that's the place for you to start. If you're sitting there having the question, I'm not sure if this is something that I can deduct in my business, think about those two criteria. And the other thing that I would encourage you to do is have a good working relationship with your tax accountant, with your CPA. Now, I'm a CPA, so I'm going to kind of be a little bit biased, and I'm going to say you probably want to look to having a CPA first, only because the level of education we need to have, we have to pass a test, we have to be licensed by the state That's our home state. We can be licensed in multiple states, and we have to go through that process. So generally speaking, a CPA had to go through a lot more to get to where they're at. And so I would recommend you having a CPA in your corner, because when you have questions about anything, whether it be a business expense or purchasing a piece of equipment, it's nice to have somebody in your corner that knows the business and that you can pick up the phone or send an email and ask them the question. And I get these kind of questions all the time. And I love it when my clients are being proactive and they're calling me before they make a decision as opposed to after. Because once you've made that decision, once you've made that move, there's only so much that I can do. I can't go back and undo what you have done. And so it's more working with the decision you've made and trying to find ways to hopefully minimize the impact on your business and minimize your tax consequences. But I've seen it happen oftentimes where a client, thankfully when I was working for somebody else, but it happens, clients make decisions, they don't check with their advisor, and then the advisor is the one that's dealing with it after the fact, and oftentimes we kind of get to blame even when it's not our fault. So have a good working relationship with your tax advisor, with all of your advisors, even your legal advisors, and don't be afraid to pick up the phone and ask for their guidance, ask for their questions. I do this oftentimes with my auto. I don't take care of my own vehicles, and I rely on somebody else. And I'll have questions sometimes before I even take the car in. And so it's nice to have somebody in your corner that you can do that with and that you trust. So I would encourage you to have a good working relationship with your business professionals that support your business. So moving on, I'm going to talk about vehicles a little bit, because this is one I see done incorrectly oftentimes and that I get lots of questions on. So you own your own business in particular, and business owners are told, well, can I deduct my vehicle? Can I have my vehicle in my business? Now, going back to sort of my little garbage truck story, I don't know why I picked that, but going back to the garbage truck, if you have a waste business, it would be commonplace for you to have that type of vehicle, and maybe there's a smaller vehicle that you would have that you even periodically drive. Well, those vehicles would obviously be necessary for the business and be put in the business. However, let's say you're a CPA like me, I have a vehicle I drive for business. However, I drive a lot. Oftentimes, a lot of the miles I put on my vehicle are really personal miles. They're not business miles. So my vehicle is not owned by the business. It's not in the business. The only thing that I get reimbursed for, or that's a business expense, are the miles that are allowed to be taken as a business deduction. So this is kind of a Pandora's box. I see oftentimes where business owners have their vehicles in the business, and if it isn't titled, if it isn't owned by the business, if you didn't actually transfer title and go through the process of having it be owned by the business, then it shouldn't be in the business, and the business shouldn't be trying to maximize the deduction for it. You can get, because what happens is, I guess I should take a step back. What happens is, if you have done that, then you need to pick up the personal use of that vehicle as income to you, because there is a vehicle that you're using for the business, but there's no way that you're not using it personally. There is no vehicle that's used 100% in the business. Oh, and that's another little tidbit for you. If you've done this, if you have your vehicle in the business, no vehicle is ever used 100%. So if you say that your vehicle is 100% used in the business, could just open yourself up for scrutiny by the IRS. And the reason I say no vehicle is, even if you have a vehicle that's used in your business, let's say you have a construction business and you have a truck that you always drive out to every site that you go to, and you have another vehicle at home that you use for only personal use. So your vehicle in your construction business is only used for your construction. But what happens? You stop at the store on the way home. You stop at the cleaners on the way home. Oh, one particular day, you decide you're going to go to your son's soccer game. So, oh, and by the way, sorry, USA is trailing right now, uh, 1-0. So, bad news. So back to my little story here. Even a vehicle that is in the business that you use primarily for the business is never 100% used because of these little stops that you may make along the way. So you would still need to track your miles for personal use, and the business then would have to charge back to you, or you would have to pick up as income your personal use of the vehicle. So because of that, my general rule of thumb is don't put the vehicle in the business and only charge the vehicle or the business for the miles that are actually used in the business. So let's get into that in a little bit more detail. The two ways that you can deduct the cost of the vehicle are either using the mileage rate, which currently is 56 cents a mile, or using actual expenses. Now, if you track them both, your CPA then can take the most advantageous one in your return, whether the mileage rate works out higher than your actual expenses or your actual expenses works higher. But that's a lot of paperwork. So you may not want to track both. You may just want to say, hey, I'm just going to track my miles, because whether you take miles, use the mileage rate, or take actual expenses, you need to track your business miles and personal miles anyway. And you need to track where you went and have a mileage log anyway. So, and the reason is, if you were to take the actual expenses are going to be taken on a percentage based on personal versus business. So either way, mileage rate, actual expenses, it's still going to be only the portion used in the business that's deducted. So you still need to track your miles and keep a mileage log. So back to what's deductible. Notice that there's a tax home that you're supposed to have, and what that basically means is your general area that you work in is considered your tax home, and that dictates then what mileage is deductible and which mileage isn't. Also, if you need to have, well, you don't need to have, but many people have a regular workplace. So for example, if I worked for another CPA firm and I would drive from my house to that place of business on most days, well, my mileage to drive to my regular place of work is not deductible. It's just going to the office. So, and that's determined partly by your tax home, and then again, if you have a regular place of business. If, let's say, you ran your business out of your house and you only went to clients, well, and meetings and all of that good stuff, the majority of those miles, I won't say all of them, but those could be deductible. And again, I say could because really the one thing that I guess I should have said for all of your business expenses is the magic two words, it depends. The IRS will use what they call the facts and circumstances of each situation to determine whether it's allowed or not allowed. And so that there is no black and white per se, there's a lot of gray. And so the vehicle thing can be a lot of gray as well. But just know that in general, your home to your regular place of work, not deductible miles. But then if I go from my regular place of work to a client, if I go from my regular place of work to a meeting, if I go to my regular place of work to a seminar, continuing education, those miles would generally be deductible from your regular place of work to that other place that you had to go to. And that can be deductible within your tax home. So like for me, the Denver metropolitan area is kind of like my tax home. So I could talk about this on and on, but I want to move on. But know that there's a lot of complicated little nuances within the vehicle deduction and what you can deduct and what you can't deduct. Uh, the other thing I can include in there, parking at your regular place of work, again, would not be deductible if you had to pay for it because, again, it's your regular place of work, as opposed to if I have to park when I go to a client meeting, if I have to park when I go to a seminar, those things would be deductible. So a lot of nuances here. And again, I would encourage you to have the conversation with your tax professional so that you can make sure that you're getting it right and you understand what you need to track and how you need to track it. Because this is one of those easy picking areas for the IRS when they see things that don't look kosher. So ask the question, get the questions answered so that you can be doing it the right way. Moving on, meals and entertainment. Okay, this is another one of those commonplace areas that I get the questions, or maybe even more importantly, I see abuse in this area. And one thing I want to point out is that your tax professional may be asking you more questions on some of these areas as well, because the IRS is starting to hold us more accountable than it used to, because they know that, generally speaking, the tax professional knows whether their clients are maybe padding in a few extra items that shouldn't be in there. And so if the scrutiny is going to come on us harder, you can expect the scrutiny from us to pass to you. So maybe we're going to be asking you a few more questions. Maybe we're going to be looking for a few more specifics. So don't take that personal, but know that if they're going to be coming down on us a little bit harder, we're going to be paying more attention to some of these items. And we're trying to protect you. So just know that that ultimately that's what we're trying to do. And if it costs you a few more dollars, tax dollars, in my mind, most of my clients tell me they want to be able to sleep at night. And so I would hope that that's your feeling too, that you want to be able to sleep at night. So looking at the first item, cannot be lavish or extravagant. Okay, now what does that mean, right? Because to one person, lavish and extravagant is something that it might be completely different to another person. And as I've pointed out, there is no fixed dollar amount for this. And going back to something I said previously, it's based on the facts and circumstances. So just something to keep in mind, though. If you were to take out a client or a potential client, or if you were to take out one of your key business acquaintances for a meal, or for I don't know, you take them to a football game or to a basketball game or to a baseball game, think about whether it could be construed as extravagance or not extravagant. Are you taking the person out for a $500 meal, or are you taking the person out for, I don't know, a typical meal at a restaurant for two people might be a $20 entree, and then it depends on if you order dessert or appetizers or anything like that, or if you have any drinks. But clearly, if you go to a really expensive steakhouse versus if you go to a more traditional restaurant, the dollar difference could be substantial. So just something to consider. Again, no fixed dollar amount, but I think in my general rule of thumb is if you even have to question it, then that probably tells you what the answer might be. The next thing here I really want to point out is that you must have a legitimate business purpose. So you can be talking about business at the meal or at the entertainment venue. You could also be doing it right before or right after. So it doesn't have to be while the event is going on, but again, there has to be a business purpose to your meeting at the restaurant, to your meeting at the baseball game. And you can't just be doing it to Take out your spouse, for example. You see that I have spouses listed on there. Um, so legitimate business purpose. And that could run a gamut. Again, there's nothing that really outlines what that means. But my general rule of thumb is this. So let's say you're going to take somebody out for dinner. Fine. Make sure that you have either on your calendar or someplace you track who you went with and what you discussed. And the easiest way to do this, because you're supposed to keep all of your receipts, is to write on the back of the receipt who you met with and what you discussed. And you can write just one simple sentence. This was the purpose of the meeting. That's what you're trying to get at. So then that way, if you ever were to get audited for your meals and entertainment, you would have this nice little folder or the shoebox or whatever you use, or maybe it's all electronic. You would have that information and it would just say those two things. Here's who was included in this business meal, in this business entertainment, and here's what we discussed. The other thing I want to make sure I point out to you is that it's limited by 50%. And if you think about that, that kind of makes sense. If I took out somebody else, my meal, my part would not necessarily be included, but the other person's would be. That's sort of the person I'm treating. And I like to think that the IRS made it 50% because they figure that this is being abused anyway. So if we at least allow only half of it, it's not quite as bad. Now, why I put spouses on here is because some of you may have your spouse work in your business. Now, if they just kind of help you out from time to time, they do little stuff and they're not really receiving a paycheck from the business, a payment from the business, then when you go out with your wife, no, that really shouldn't be a business deduction regardless of whether you talk business or not. Now, if your wife is on the books, then that can change, particularly if she's accompanying you with some other clients and maybe you're taking them all out to a play or you're taking them all out to a ball game and she's a regular part of your business, then that including her shouldn't be a big deal. But again, I say shouldn't because the facts and circumstances may change, and I don't want anybody to think that there's a blanket statement that kind of applies to it all. Let's see, I'm trying to think if there's anything else I really want to cover on meals and entertainment. Like I said, this is one of those areas I see get abused, so please be careful here. Make sure you're keeping your receipts, make sure you're writing down who you met with and what you discussed, because that way, if that information is there and you get audited, you're going to be protected and the IRS is going to be like, wow, this person has some really good records. And I'll talk about record keeping at the end because I do want to point out a few things. Travel, this is another one of those areas that I see lots of questions and sometimes I see some abuse. So business trip versus vacation. If it's a full business trip, so for example, I might go to another city for a seminar because I need to have continuing education every year, and so I buy a plane ticket to travel to that destination, I buy a hotel room, and then the hotel room, let's say, is for 3 days because I have 3 days of training, and then I fly back. So that trip, 100% business, pretty much all of those expenses related to it are going to be deductible. Now, again, I say pretty much because I can think of things that maybe I did on the trip that would be not deductible. Maybe I had a personal, in the evening, I went by myself to a basketball game. So that would be a personal expense because I did that on my own time. Maybe, though, if I went with somebody I met there and it was going to be a key business relationship, then maybe that basketball game is deductible. Now, if there's some vacation attached to it as well. So in my example, let's say I stay an extra 3 days after the fact, then those 3 days would be personal. My meals attached to it would be personal. Some of the airfare might be not deductible. And again, I say might because it's a facts and circumstances. But that piece of it for those 3 days would be not deductible because it was personal time versus business time. Travel outside of the U.S., I'm using the U.S. as an example. I don't know if we have people from outside the U.S. that are on the webinar today, but if your home is in the U.S. and you're traveling outside, the rules change slightly as to what's allowed and what's not allowed. And I'm not going to go into all the specifics here, but I just want you to know that there are some differences. Also, for luxury travel, luxury water travel on cruise ships, there are limits to your deduction as well. And again, if you think back to one of the things I pointed out with the meals and entertainment and extravagant versus non-extravagant, those rules are applying here. And so that's why there are some limits when it comes to cruise travel and luxury water travel. Also, conventions, if you have a convention meeting that's on a cruise ship, notice that there's a $2,000 limit per year for those costs. So again, think about the type of trips you're taking, if they're related to business or whether they're not related to business. There can be limits on these items, and so rely on your tax professional. Ask them the questions so that you know what's allowed and what's not allowed. Now here's the thing. I hear some crazy stuff though from other people. I know somebody who their tax professional told them to drive from one area of the country almost across the country so that they can deduct the miles, and then even though it was a personal trip, not a business trip, and then they would say to them, well, when you go to the other city, just pick something up, say you went to this, so that you can say you went to this event, this convention, this whatever it was, to try to make the trip see a business trip. Well, first of all, even if the person did attend, let's say, 1 day out of 5 for that trip, you have 80% of it being personal and only 20% of it being business, then that would probably be how your miles should be split. But potentially the IRS could even argue that all of it was personal and the person was trying to disguise it as business. So really be careful here. Ask the questions, be educated, make sure that you're making an informed decision versus an uninformed decision. If you were going to take your spouse, so if I was going to take my wife on a trip with me, what would be deducted? Well, she doesn't work in the business. She's coming along just really for personal reasons. So again, splitting up some of those costs, her meals wouldn't be deductible versus my meals being deductible. What if we went to an extravagant dinner to just have some fun versus or more of a regular dinner? So it can get really complicated and convoluted, but know that if your spouse doesn't have a legitimate business reason to be there, then you're going to be splitting up some of those costs, personal versus business related, for yourself. Okay, moving on. We're starting to get close to running out of time here. I want to talk about record keeping, and I've kind of touched on it a little bit, but good record keeping really is a key, and especially when it comes to your mileage. You need to be keeping a mileage log. You need to know where you went on what day and how many miles it took. There are some wonderful apps that you can use on your cell phone that'll track where you're going. Some are free, some cost nominal fees, but have a little bit more functionality and allow you to download reports. That could be a great way for you to do it. You can go old school and use a paper and pen, use a ledger. You can, or a notebook. A notebook's a great way because you can just toss that in the car. Or you can use an Excel spreadsheet, whatever's going to work for you. If you have employees and you send your employee to from your place of work to a I don't know, pick up supplies or something, that would be deductible mileage. I assume you'd be reimbursing the employee. But again, know that keeping good records is really important. And it's really important also, not just for the mileage, but for the meals. Like I said, you're going to want to include who you met with and what you discussed. And keep all those receipts. Just because you have a credit card statement, just because you have a bank statement, the IRS is still really looking for you to have the actual receipt from the place that you went, from the event that you attended. So just keep that in mind. Keep good records. Oops, sorry about that. Take the time to update and maintain your files. Whatever record keeping that you are doing, whatever your method is, if it's all electronic, if it's some electronic, some file, all file, however you do it, make sure that you're taking the time to keep that stuff up to date. Because what I see happen often is it's one of those things where the business owner is busy, they decide that that's the time that they can spare, so they're not going to keep their records up, and they'll just worry about it when something happens. But that's the worst time you want to worry about it, because it really is difficult to go back and try to rebuild what happened in the past, or to remember what happened in the past. So I would encourage you to take the time to keep your files current and up to date. And as far as what you need to keep, the IRS has published retention guidelines for how long to keep various records. So that's a great tool for you to use. You can get it on the IRS website. It's a great tool for you to use to know how long you should keep different types of records. There was something else I wanted to say for record keeping. Let me think about it. Nope, it's escaping me. Keep good records. Follow the IRS retention guidelines as a general rule. Oh, I know what I wanted to say. Those guidelines, though, can be blown out of the water, so to speak, or cannot apply if the IRS determines that there's fraud involved. If the IRS determines that a taxpayer knowingly was trying to defraud the IRS, so let's say taking a deduction that they know they shouldn't have taken, and the IRS can prove that, well then they can open up everything, and the retention guidelines don't apply anymore. So it's something to keep in mind. And be honest with you, it is not worth trying to save yourself. If you're in the, let's say you're in the 20% tax bracket or 15% tax bracket, is it worth saving 15 cents on a dollar of deduction that maybe you shouldn't be taking? So just something to keep in mind. I mean, oftentimes I will see that taxpayers trying to do something, be like, look, this is what it's really saving you. It's saving you $20. So do you really want to put into scrutiny this particular item for $20? And I think once sometimes you put the cost benefit to it, oftentimes the person will be like, nope, you're right, it's not worth it. And again, most of my clients are ultra conservative, and again, they want to sleep at night. And like the picture, they don't want to be running from the IRS. They want to be focused on running their business, running a successful business, and not having to worry about some of these little nuances. So, and I agree with them. I think that's the best way to go. Do things the right way, and then you never have to sweat it. So, I've gone through most of the things I want to go through. I think we can open it up to any questions that you may have.
Yes, thank you, Mr. Orlando. Let's move on to the questions. I have a few questions here. Let me take up the first question. Are there any exceptions for deducting medical expenses of a dependent?
So I assume we're talking medical expenses on your individual return. There are always exceptions to the rule. Generally speaking, for medical expenses, think of the sort of our general rule for a business expense. is it necessary? There's a whole list of medical expenses that are allowed, and there's more than you think. Glasses, contacts for women, their birth control pills. If you have a person that has special needs, there are all kinds of deductions that can be taken with a special needs person if the item is something that is needed for them. Maybe a wheelchair ramp, some other modifications to your home to allow that person to be able to function. There's quite a slew of medical expenses. Now, the thing about medical, though, is it used to be you had to pass the 7.5% floor of your adjusted gross income to be able to deduct the medical expenses, and that has gone up to 10%. And I'm talking for people who are below senior citizen age, because over 65, their threshold is actually lower. They're allowed to take a little bit more, and because they generally have less income and higher medical expenses, oftentimes the elderly are the ones that tend to get the biggest benefit from the medical expense deduction. But it's there for individuals. I just don't see it used as much on individual returns because it's usually a big number that the person needs to hit on their return to be able to take the deduction. So for example, let's just say your adjusted gross income is 100,000 and where you would have a 10% floor, you would have to have more than 10,000 in medical expenses to be able to deduct. So I don't see it as much on the individual returns as I do, unless it's a senior citizen. The other thing is, in your business, you can have, if you have a plan, a medical plan for your employees, that would be a deductible business expense. But then your employees, their coverage, unless you're giving them some additional money for, let's say, to fund an HSA plan or something else like that, any employee expenses that they have as medical expenses would be personal expenses, unless, of course, they were injured on the job or somehow hurt performing a function for you, and then it gets kind of convoluted. So I hope I answered your question.
Yes, we'll move on to the second question. Can tax on freight or shipping costs be avoided?
Tax on freight or shipping be avoided.
Yes.
Now, your tax, that kind of a tax is a local tax, and so the tax is going to be based on your local rules. And for example, here in Colorado, the sales tax is really challenging because each jurisdiction can kind of do things their own way, and so you have some cities that uh, the that the state collects for. You have other cities that collect their own. You have counties that collect their own. You have counties that are collected by the state and remitted. And the rules can be really complex. So without knowing exactly what jurisdiction you're in and what tax you're trying to wonder if it can be eliminated, I can't specifically answer that question. The one thing that is challenging about tax in general is that the kind of what I said before is that what applies and what you can do is based on the facts and circumstances, and it changes for each particular situation. So my best advice for you with this is either check with me offline or check with your tax professional, because I need more information to really answer that question, to know whether it's something that should be taxed or shouldn't be taxed.
Okay. Move on to the third question, and I think you will have to do another webinar with us for that, because that question is, would you be doing a webinar regarding tax payments?
Regarding tax payments?
Yes.
I could. I would need to know specifically what type of payments you're referring to. I don't know if you're referring to estimated payments for tax on the business, estimated payments as a self-employed person. I don't know if you're talking about remitting payroll taxes or sales taxes. There are so many different facets to taxes. Sometimes it makes my head want to explode. But I could possibly, if it be something that would be of interest to other people, and if it is a topic that really needs delving into, but we need a little bit more specifics to know whether that's a yes or a no.
Okay, thank you. Let's move on to the fourth question. Can we show expenses for continuing education to maintain licensing and to improve skills?
Absolutely. Continuing education expenses are deductible, and those could take on a variety of types of expenses. It could be attending a conference, it could be attending a seminar, it could be the cost of having taking a webinar or an online class, or having access to a database of online classes, so you have a subscription service that you use. It could be buying a reference book to use in your business. There's so many different continuing education expenses that would be deductible, but absolutely, if it's, again, thinking back to, is it ordinary in your type of business, is it common, and is it necessary? So absolutely, it's definitely necessary. For me, it's not just continuing education, but I also have licensing fees that I have to pay. So all of those, yes, absolutely deductible. If you're a medical professional and you have to maintain your licensing and you're maintaining it in various states, those licensing fees, all of those would be deductible expenses as well.
Great. We have come on to our last question. And the question is, what is the stand regarding taxes for home offices?
Okay, I didn't cover home office deduction, but this is one of the areas the IRS has been really looking at harder. And it is definitely allowed, but I would be cautious in that area. If you have a home office and you work out of home, then yes, you can absolutely take it. If you own your own home, then your deductions for the things that could be your property taxes, your interest deduction, if you have a mortgage, those are your two biggest ones. HOA fees would also be allowed. Those items would all be deducted on the schedule for your home office business deduction, and then it's based on a percentage of the square feet that you use. So let's say 10% of your home is used for your home office, 10% would end up on that form going against your business income, and then the other 90% would still end up on your Schedule A on your return. So hopefully you wouldn't be losing anything. But there are some additional things you could get on the business, your deduction on your home office versus your Schedule A. And HOA fees is one of them if you paid those. Also, repairs and maintenance counts, especially if you, let's say your home office, you repainted, so that cost would count. Anything that you buy direct expense for your home office would count. And the other thing, though, is, and I don't know if the IRS ever comes out to visit you, but you want to have dedicated space. So, and that's what they want to see. So it should be an office that's used only for your business. You shouldn't have a playpen set up in there so you can watch your kids and all their toys. It really is supposed to be a dedicated space. But again, keep in mind that this is one of the areas the IRS is really looking at. So you want to make sure that it's legitimate. You want to make sure that the costs that you're including are legitimate. And if you have questions, ask a tax professional. You could even potentially have a home office deduction even if you have a regular workplace. But that gets really complicated, so I won't get into all those details at this time.
Okay, thank you, Mr. Alana. Thank you very much. Mr. Alana, thank you very much for educating us today on business expenses and for taking time from your valuable schedule. Thank you very much for being with us today as well. Well, we do have a little more time, but unfortunately our education on air comes to an end. And until we see you again, it's a goodbye from us here.
Bye, everyone.